Hello everyone and welcome to Commerce classes. So today we will be practicing managerial decisions based on sales indifference point with one more example. In our last class we have studied sales indifference point and how it affects management. So today we will be understanding the whole process through one more question. Now let us see the question. Two firms sell same type of product in the same market. Their budgeted profit or loss for the year is given this much. So you have two product lines, product line A and B. If you sell A 5 lakh, 6 lakh sales and variable cost for these two levels are given and fixed cost is also given. Now you see in product B, your fixed cost is more, 30 to 70,000. But when you look at variable cost, your variable cost is higher in case of product line A because at an activity level of 5 lakh, your cost is 4 lakh. But herein, with the same cost, you are having an activity level of 6 lakh, isn't it? So that is why the choice is difficult. Because you save on one account, but you have to incur more on the other account. You save variable cost here, it is lesser here. If you take the percentage, it is 66%. And here it is 80%. So you save money here. But then you will have to put in more money on the fixed cost. So where will the level balance? That is sales indifference point. Okay. So along with sales indifference point, we have included some more questions based on break-even point analysis. So profit is given. Now these are not comparable figures, I can say, because the activity level is different. So you cannot compare the two. We need to use comparison tools for decision making. Now first thing is calculate PV ratio, then break-even point, and likewise we are to make the calculations. Now we are not given units of production. So our all calculations will be done in rupee terms. Now before we study what is to be done, let us revise this cost sheet. We know how to revise it, isn't it? And we should make the basic calculations. We are doing this right in the beginning, reason being we know that this question is of CVP analysis. Otherwise, we will be reading the question properly and then we will start with the solution. So now we will make contribution based cost sheet and we will make the basic calculations. Product line A, product line B. Okay, so we start with sales 5 lakh. Had we been given say selling price per unit, we could have calculated per unit information also by dividing it the whole cost with the number of units. Like if you are having say selling price of say 50 rupees per unit, then it implies that you are having here activity level of 10,000 units and herein your activity level is 12,000. Okay. Now less variable cost which is 4 lakh and 4 lakh. So your contribution is 1 lakh and 2 lakh. Now deduct fixed cost from here, 30,000, 70,000. So what we have done is we have simply rewritten our cost sheet on the basis of contribution so that we can make calculations. Now this is your profit. So our PV ratio will be, this is the first thing that we do in every calculation for CVP analysis or contribution per unit. So PV ratio is contribution upon sales into 100. So contribution 1 lakh upon sales 5 lakh into 100, that is 20%. So contribution 2 lakh, sales 6 lakh, that is 33 and a 33%. Okay, so what we get here is that in case of product line A, you will be having lesser contribution, but you are saving on fixed cost also. Herein you will be having more contribution, but then you will have to incur more on the fixed cost also. So you never know at what stage the two methods will break even. So that we can solve. Now your question further says solve break-even point. Now we will be calculating break-even point individually for each product line. So break-even point is fixed cost upon PV ratio. So fixed cost is 30,000 upon PV ratio 20%. So for product line A, you will break even at 1,50,000. That is, if your sale goes beyond this, you will start making profits. Now here in case of B product line, what will happen? Your fixed cost is 70,000 and your contribution ratio is 33.33, that is 2,10,000. It means that you will have to wait up to the sale activity of 2,10,000. If you reach this, then beyond this you will be making profit, but below this you will be making loss. So in a way, in general, if nothing else is asked or given, in general we can say that if the demand is increasing, we should go with this method. But if the demand is falling, then this method is better, because you will at least be making some profit starting from 1,50,000 rupees of sale. Herein you will have to wait up to 2,10,000. This is in general. But in reality, because of the cost dynamics involved, in one place you are having lesser variable cost, but then you have higher fixed cost. So how will one benefit cancels off the other? That you will have to see. Either you will be making the table for different level of activities, or we can sort it out through cost indifference point or profit indifference point here. Okay. Now, in simple terms, your question asks which firm is likely to perform better in case of high demand. Now, when demand is increasing, then it is better to go with higher PV ratio. So, this is a general question. We are not asked the level of activity. So, in general, we can say that when there is high demand, we should go with second method, because it is having high PV ratio. But when it is a low demand, when demand is shrinking, then we are not looking at the contributions, we are looking at the cost. So we'll have to go with this method, okay, because this is having lesser fixed cost. So you have to cover cost, you want to make some profit, so you will go with the minimum cost possible. Because variable cost is not relevant here, because variable cost will be covered by every new sale. Every new sale will contribute 20%. So variable cost is deducted therefrom only. So we have to look at the fixed cost dynamics. So fixed cost is lesser here. So you will go with product line A when your demand is shrinking. But when your demand is increasing, then you will go with the higher profitability, right? But this is a general idea. But in reality, you will find that it is not so. There is a margin wherein even when the demand is more, still B will be lesser profitable. And that is how that is what we see in the cost indifference point. So this is just a generic, you can say, assumption. But exactly in a given situation, which is better, which product line is better, that will be chosen using cost indifference point or sales indifference point. So next is sales indifference point. So when we are to calculate sales indifference point, then it won't be calculated in the tabular form. Our tabular work is done here. So sales indifference point is a break even of both. When both of the methods are at the same footage, that is, both methods give you same profit. So change, or you can say difference in fixed cost upon difference in PV ratio. So this is 40,000 rupees of differences in the fixed cost, and in the PV ratio there is a difference of 13.33%. So that is 3 lakh. So this is your sales indifference point. That is, at this level both the product lines will give you same profit. So your decision criteria now will be that whether you are having activity level above this or below this. So if your activity, that is units of production or sale, are below this level, then you should select the product line with lower fixed cost. That is A is chosen. Okay. And in case the activity level is above 3 lakh. Why we say this? Above 3 lakh will imply that you have covered all the cost and you are at the same level of profit. At this level, both the product lines are giving same profit, and you can calculate that also. So now, if you go beyond this, you have already covered the cost, you are at the profit level and profit is same. So every additional sale will contribute here 20% for A line and 33.3% for product line B, which implies that we should choose a product line with higher PV ratio. Okay. So now you will be selecting B. So this is how we base our decisions on sales indifference point or profit indifference point. So further our question says that what will be the profit when sales are 2,70,000 and 3,15,000. So let us see whether our decision is correct based on this analysis or not. So suppose our case 1 is when your sale is 2,70,000. Now a sale of 2,70,000 will imply that based on this managerial decision criteria, if you are below this sales indifference point, you should choose A with the lower fixed cost. So we should choose product A. Let us see whether our decision is correct or not. So we are coming here again with the same calculation. Now how do we calculate profit? So profit formula is, if we are having break-even points with us, we can directly calculate profit as actual sales minus break-even point into PV ratio. If it is a case of PV ratio, otherwise we can take contribution per unit if we are making calculation in unit terms. So your actual sale is 2,70,000. Break-even point of first method is, first A is 1,50,000 and their PV ratio is 20%. That means 24,000. Whereas profit for product line B will be 2,70,000 minus their 2,10,000 is break-even point. So into 33 and 33%. So that is 20,000. So you see, product line A is giving more profit and you have chosen that only based on this decision criteria, isn't it? So this is how you can explain. It means that this higher contribution here is not able to cover the higher fixed cost. Okay, so B is not chosen, A is chosen. Then let us say another case. Suppose your sale is 3,15,000. Now how will the scenario change? Now as per our decision criteria, now we should go with B because break even at 3 lakh has reached, which means that you have covered all the cost and you are at same level of profit at 3 lakh. So every additional sale is going to give you more profits in case of B with higher PV ratio. So we should choose product line B. Let us see whether this decision is correct or not. So product line A, profit is sale of 3,15,000 minus 1,50,000 into PV ratio 20%. This is our formula, 1/5 of this. So this gives you 33,000. Now for product line B, it will be 3,15,000 minus their break-even point 2,10,000 into 33 under 33%. That is 1,05,000 into 33 under 33%. That is 35,000. Okay, so this is giving you more profit. So you are correct or you are right in choosing a product line with higher PV ratio. Just remember, this is a break-even point. Cost indifference point is a kind of break-even for the two product lines. So if you go below this, then choose a method with lower fixed cost, because your benefit of fixed cost, lower fixed cost is not cancelled by the higher variable cost. So you should choose this lower fixed cost. Whereas in this case, when you go beyond this, then you are at a profit level. So you should choose higher PV ratio. So this is how sales indifference point can be used for making managerial decisions regarding choice of the different companies or choice between different product lines. So I hope this is clear to you. So you can practice some more questions on this decision and stay learning and practicing. Stay happy. Thank you.